So we've all heard the statistic that 90%, 95%, 99% of traders lose money in the market. So in this video, I'd like to cover why that is. But first, let's get a quick update on how our portfolio YouTube Capital is doing. So we're still sitting at $1,000 here, but we're going to be taking our first position into Snapchat based off of last week's top comment. So thank you, Luke, for sending that in. And now we'll be adding 5% of the portfolio into Snapchat by the time you are watching this video. We've also had 5 subscribers since last week's video, so again, I'll be adding $1 into the portfolio for each subscriber that we get at the end of each month. Also, make sure to comment below your trade ideas, and maybe your trade idea will make it into the portfolio by next week's video. Now, getting back into the video, I think one of the main reasons why so many traders are losing money in the market is because they don't understand this hierarchy of importance. So there are several factors that are going to affect the price movement of a stock, and understanding the hierarchy of how significantly each factor will affect it is going to be crucial in determining which factors to focus on when you're trading the markets. So for example, in an intraday to 1 month time frame, the most important factor is going to be institutional capital movement. And then the second most will be stock specific news, then the overall market, then technical analysis, and then long-term fundamentals. And by long-term fundamentals, I mean historical fundamentals. So just to break this down for you guys, to show you what most traders are doing, they may be using technical analysis. For example, a stock may be coming down and about to hit support, and they're buying up the stock because it's hitting support. But there's some other factor that's going to affect the stock more largely, and it's the reason for why the stock is moving down. So if you have institutional capital movement outside of the stock, if they're selling the stock, then it's not going to matter what technical analysis tells you. This is a bigger factor on whether the stock is going to move up or down, and in this case, it's going to move down. And the same thing for stock-specific news. If there's a bad piece of news on that stock, it's going to move down, and it doesn't matter what technical analysis tells you. If it's a significant enough piece of stock-specific news, the stock's going to drop. And the same thing with the overall market as well. If the overall market is dropping, that technical analysis will not tell you what the stock is going to do. So what I've seen most successful traders do is they'll use technical analysis as the last part of their process. So they'll understand what institutional capital is doing. They'll understand what stock-specific news is out on the stock. They'll understand global macroeconomics and what the overall market is doing. And then they'll use technical analysis as that last part to tell them whether or not they should buy or sell the stock. But if there's one of these factors that's trading against their thesis on the stock, then they're not going to use technical analysis and say that, oh, the stock is hitting support, so I should buy regardless of the market moving against me, or a bad piece of stock specific news. Now, moving into a longer time frame, you see things shift around a little bit. So in a 1 month to 1 year time frame, you see that overall markets are going to be the biggest factor that affects whether a stock will move up or down. Then following that, you have stock specific news, institutional capital flow, long-term fundamentals, and again, historical fundamentals is what I'm talking about when I'm talking about long-term fundamentals, and then finally technicals. So just to drill down this concept a little bit further, let's think about this from the perspective of long-term fundamentals. So long-term fundamentals are going to be your earnings or your dividend payouts over the past 10, 20 years. So if a stock's been paying out a consistent dividend for the past 10 years or has been earning consistent earnings like a Ford or a Coca-Cola, for example, for the past 10, 20 years, that is going to be your long-term fundamentals. But now that's not going to drive the price of the stock in that 1 month to 1 year time frame as much as these other factors will. So if you're buying Coca-Cola right now, it doesn't really matter how much earnings it's made in the past. It matters about what earnings it'll make in the future. And that is going to be more determined by the overall markets or stock-specific news, for example. So if you have the overall markets moving against you in the short term, in a 1 year time frame, you have the overall markets crashing, Coca-Cola is going to also crash. It doesn't matter that it's paid out a dividend or that it's earned consistently for the past 10, 20 years. it matters about what's happening in the short term, that the overall markets are going down, and that's worrying people about consumer confidence and how much future sales will be affected for Coca-Cola in this example. And you see many swing traders and even investors exhibit this type of cognitive dissonance. They'll be buying up Coca-Cola, for example, and they'll say, oh, well, it's had earnings for the past 20 years, consistent earnings, consistent dividend, consistent cash flow. So why shouldn't this stock go up? Well, the reason is that if the overall markets are going down, the stock's going to go down. It's just how it works, because stocks are priced off of future earnings, and they'll fail to accept that reality, and they'll be trying to go against the market. They'll be trying to go against what logic is telling them, and for that reason they'll lose money within the market. And now looking at a 1 year plus time frame, you see that long-term fundamentals are the biggest factor that will cause a stock to move up or down. And again, this is because stocks are priced based off of expectations for future free cash flows. So if you have solid long-term fundamentals, that is going to help your stock in determining whether or not it will produce long-term free cash flows in the future. But that's not going to actually show or be affected within the stock's price until a 1+ year time frame. Could even be 3 or 5 years. And the reason this takes so long to revert back to the mean is because, again, there are other factors at play, such as the overall markets, technicals, institutional capital flow, and stock-specific news that are affecting the stocks in the short term. So if you are a value investor, for example, you're going to want to take advantage of these other factors driving down your stock's price, as long as long-term fundamentals are solid within the company. So understanding each one of these factors and how much magnitude it plays within each one of these time frames is extremely crucial if you want to actually succeed within the markets. And that's why so many traders are losing, because they're using factors such as technical analysis when there are other factors at play. That doesn't mean that technical analysis is completely false or completely useless. It just needs to be used in conjunction with these other factors, or in the absence of these other factors. So if the overall market isn't moving significantly one direction or the other, then maybe you'll be able to get away with using technical analysis on a stock and actually succeeding. But you have to worry about these other factors at play first before utilizing a technical analysis strategy. So one last piece of information to keep in mind here is some of these factors may flip based on the magnitude that it has within the market at that time period. So for example, if you have the overall market moving sharply higher, it doesn't matter if that stock has a small piece of stock-specific news, a small piece of bad stock-specific news. The overall market will win in that case and will cause the stock to go higher. And that applies to many of these factors, but keep in mind that it needs to be of significant magnitude. So the overall market would have to significantly move higher in order to beat these two factors, if these two factors are playing against the stock in that same time frame. So there you have it. I understand this video was a little bit more advanced than some of my previous videos, but I wanted to share this crucial piece of information just because I've seen so many traders, whether they're beginner or whether they're advanced, still using inferior factors against superior factors that are going against them, and they'll just experience this cognitive dissonance and refuse to get out of their position, even though there's a bigger, larger factor at play telling them to get out. And if you're able to actually have discipline and listen to the market when it's going against you, then you could definitely be a very successful trader. So I hope that video helped out, and thank you guys. I'll see you next week.